Thanks for tuning in. Welcome to another Tuesday night podcast. Tonight we are live, and we have the DeRosa Group on tap here. We have their returning contributors here to our Tuesday night podcast, and we're excited tonight. We're going to talk about apartment housing, and all across America we have such a shortage of housing, and I think a lot of the buyers are living in apartment complexes right now, no matter whether they're big or small. I'm Todd Sachs. I'm a broker in Maryland. Here we serve residential and commercial clients of both purchasing, selling, and tenant representation. And we're happy to have you guys tonight, Matt Faircloth and Justin Frazier. Guys, if you're tuning in with us, we want you to comment your questions. You may be a tenant that is living in an apartment or trying to live in an apartment, and maybe you're on a wait list. You may be an investor. And you're looking how to tap into this what appears to be an amazingly thriving market. Uh, Everywhere you look, everybody's talking about investing in apartments or multifamily housing. But guys, we appreciate you being here. Thanks for returning to our show. We have Matt Faircloth and Justin Frazier with us. So, guys,
Hey,
why don't we
Todd.
start with you, Matt? Just kind of introduce yourself to everybody, and let's get this party started.
Thanks, Todd. It's great being back here, man. I appreciate you talking to a fellow Baltimorean like myself. And that. So I'm Matt Faircloth. I'm one of the founders of the DeRosa Group, and we're a company that's dedicated to transforming lives through real estate. We own apartment houses, a few commercial assets, and we do all of that through private capital and through those that want to make passive hands-off investments and make great cash flow alongside of doing good with the money that they're making great returns on. So that's that. And that's what I'm all about. I'm handing the baton over to Justin.
Hey, Todd. Yeah, happy to be back, man.
What's up,
Thanks
buddy?
for having us here. Really excited to do the show again. Matt and I are partners in all the apartments that we own now, up over 1,250 or so, with a lot more coming. Hope we get to talk about that tonight. We've got some really exciting stuff coming. I do asset management, so I write the business plans and execute them, and I make sure that the plans that we put on paper and tell our investors all the things we're going to do, the rent raises, the capital expenditures, the safety improvements. I make sure that all gets done on time, scope, and budget, and make sure that we're delivering not only for our investors, but to make our apartments a better place for our tenants to live as well.
Yeah, you said 1,250 units, guys. We have serious operators here. I mean, tonight is your night. If you're listening to the show right now while we're live, we would love to hear from you. Go ahead and comment your questions. You have the ability right now to talk to these guys and get their opinions, ask them your questions. But if you're listening after the show, go ahead and comment your questions, and we'll be sure to get back to you, try and point you in the right direction. I know both of their stories, and we have a previous video out there that you can search on our channel. but really, they started. I mean, if you listen to their story, they started as small investors. I mean, like a lot of people do. I mean, it's not just all of a sudden, boom, one day, you buy an apartment complex. If you really weren't born into a family of multifamily developers or owners, it really is just a dream for many, and you have to start somewhere. So, tonight we're going to talk about syndication, whether you even want to be an operator, how you may be able to invest in multifamily. We see a lot of that. But we're really going to talk about the supply side of things, and everybody wants to know what is going on. I mean, that's really the question right now. It's here in Maryland, and I'm sure whether you're in New Jersey or Florida, no matter where you are, if you're in a major city, you're trying to find a place to rent. You're having a hard time. I mean, there's wait lists, guys, right? I mean, we're seeing it. Kind of tell us, how long have you been apartment operators?
I've been in business as a real estate landlord for 16 years. To apartments, I bought my first apartment building, which it was actually my first duplex. I bought a duplex, about 16, 17 years ago when I first got started. Larger than that, we bought a string of 4 families, and that was about 14 years ago, give or take. And then Justin and I had been owning larger assets. I mean, beyond the 4 to 5 unit stuff, Justin and I are involved in, 80, 90, 100, 200, 300 unit complexes at a clip, right? So we've been working together for what, Justin, about 5 years now? 4 years?
Well, we've been working together on 4.5 years or so.
Yeah. And managing larger assets.
Yeah.
Before I met Justin, I didn't have a team to take down larger properties with property management staff and things like that. So before that, we were our largest property before Justin and I started working together was a 49 unit. In that, so you can still call that an apartment house, but the large like complexes, in that Justin and I have been doing for about 4.5 years now, like that, like you have here.
Oh yeah,
yeah.
That's a 152 unit that we have in Lexington, Kentucky that we picked up this year.
Yeah, and this one, and Todd, if that was an off the market deal, and we could talk about getting off the market deals or whatever, but Justin and I were very proud of that deal. That was DeRosa Capital 12, a deal that we closed in July, but that was just through relationships that we got that deal.
So what have been? I mean, we talked about, I think it was in June of 2020. We were just kind of figuring this stuff out with the pandemic. I think we were right in the heat of everything. What have been some of the biggest challenges that you've had to face as apartment owners this year, 2021?
Challenges during a global pandemic? What? We operate in mostly the C class. That property that you just showed is a B class property that we bought this year, but most of our portfolio is C class. And the C class tenant base got hit hard during the pandemic, and a lot of the places they work closed up or significantly cut back hours. And so we saw a lot of tenants face some real hardship. And for a while, there was aid in quotes, but it wasn't coming, and money was locked up in the system. We couldn't evict because of the eviction moratorium, and these tenants just accumulated month after month after month of unpaid rent. And I would say for the most part, not because they didn't want to, but because they were trying to find a job or whatever. Some tenants, probably took advantage of the situation, but I would say for the most part, we have pretty good tenants, but just got into a kind of a rough situation. And so we had to deal with a lot of bad debt, a lot of owed rent to us. But of course, the insurance still has to get paid, and the mortgage still has to get paid, and the leaks still have to be fixed, and on and on. I'm happy to say we did not cut back any of our staff. We kept employing all of our teams on all of our properties. But we really struggled with collections for a long time through 2020, through the early part of this year in 2021. We had a hard time. And the eviction moratorium sort of stopped and then started again. And we had a hard time, but probably towards the back half of this year, finally that aid started getting processed. And so we had months of back rent. Some tenants, 6 months back, and they're paying 3 months forward if they can get approved. But the aid, it wasn't like one national pot of money and you just apply to that national pot of money and everyone gets it. It's they disseminated it down. And so all the local municipalities or cities got that money and processed it on their own time frame, in their own way, with their own set of paperwork. And so we had struggles where we have properties in Kentucky that money kind of got locked up, and then all of a sudden the county in Forsyth County in North Carolina started processing really quickly, but then Fayetteville had a hard time. And so it's like it really back and forth and really hyper local to where we got some aid and where we got support. But I would say now, as we're coming out of the pandemic, the moratorium has expired. We have tenants who are either catching up and are applying for aid. And the aid now is actually functioning, and it's not that you have to sit for 6 months. We apply for aid and it's maybe 6 to 8 weeks and we're getting it. It's a lot better time frame. And so they're either in that process or they're just not paying, and the courts are giving us judgment for the units. And so we are receiving possession on a lot of units where the tenants decided not to pay, decided not to apply for aid. Those tenants are now leaving our properties.
So when you say, just so the audience understands, when you say most of your properties are B and C, can you kind of give a little description on what that means?
I can run that down. So the alphabet of multifamily real estate goes A through D, right? There is no F, even though there's been some properties that would qualify for it if there was, that I've seen. So A is your typical new construction, and it's either like heavily rehabbed or newly constructed properties. It is up to today's standards, and it's got today's amenities. So an A apartment complex is going to have your community room, your gym, and not just a gym, but a really nice gym. And not just a pool, but a nice pool and a grilling area, whatever. It's going to have a lot of today's modern amenities, and today's finishes, 9 to 10 foot ceilings, probably granite countertops and all that. So just finishes you see on the new construction side. In addition, the rents in A class real estate are going to be well above. They're designed to serve above the median. So if a median income in a market is $45,000, those that live in an A class property are likely earning $80,000 joint income between the spouses. They drop down to B. B is built a little bit, a little earlier vintage. Probably still the 1980s, 1990s, something like that. Maybe a big facelift or something like that. Just lower down on the asset class, but still nice. You got C, and C is what you would call workforce housing, and C can go either way. See, there can be nice, well done workforce housing, like Justin and I are proud to say that we own and manage. Then you've got properties that are just run down, or a nice way to say it is deferred maintenance and things like that. So a C-class property is likely built in the 60s, 70s, and probably hasn't had any, maybe didn't get a facelift in a while, like a lot of the rundown Cs are. But you can take a 1960s, 1970s vintage or 1980s vintage property and keep it up fairly well and maintain it to where it'll survive another 30, 40 years if you keep it up right. And that's what Justin and I have learned how to do, is to run really well C-class properties. Now, then you got D properties, and D does not necessarily built in the 30s, 40s, or 50s. It is just anything I just said that's been allowed to run down. And that could be, you can have a 1980s or a 1990s property that's a D. But it's just, there's been tons of deferred maintenance. They're not keeping up with the roof. They're not keeping up with the property. And to be straight, those that live in a D-class property are those that have to live there. They don't live there because they want to. And because of the condition of the property, the landlord can only charge but so much. So typically rents are below market. D properties tend to attract a lot of crime. They tend to attract, just an element you don't want in a property, but just an element you can't really keep out because the property's so run down. You really can't regulate who's living there, who's not. So that's a D-class property. So it goes A, B, C, D. And people always go if we want to compliment a property, go B plus or B minus or C plus, so we tend to give them subgrades inside there too. So that's the alphabet.
So Matt, when you get into the larger multifamily apartment buildings, are there still the same kind of rental license standards, as far as, I know here in Maryland, I don't know about other states in the country, but we have to have a rental license in pretty much, I think, any county here, where it has to have a inspection, have a certain standard of living. How does that apply to the larger complexes?
Depends on the state, my friend. It doesn't in Kentucky. So first of all, Justin and I are recovering Trenton landlords. Okay.
New Jersey.
And so we know all about certificate of occupancies and rental licenses and inspections and code compliance and everything like that. And inspections every time you sell a property, inspections every time you lease out a property, inspections on top of inspections and inspections to make sure the inspector did their job, right? state registration along with local municipal registrations. That is the lovely state of New Jersey for you. Pennsylvania also has landlord licenses in most of the places that I've dealt in. But Justin and I most of our properties are in North Carolina and Kentucky. There are no certificate of occupancy requirements. There are no rental licenses that I know of, unless our property managers deals with it. We never even hear about it, but I don't think that there is, because Justin would be telling me all about it if there was. And then, but there is, you pull permits, right? So if you're doing permitted work, you still have to pull a permit, but that's where the government gets involved. And if the tenant wants to file a complaint about a issue, it becomes a tenant regulated space. So the tenant can call the town and say, hey, my roof is leaking, or my quality of living is not up to standard. The town will come in, and if they do, they will throw their book at you. They'll come in and fine you and this and that. You got 24 hours to fix these things, whatever. So it is more of a public governed space. And to be straight, what I like about it is the inspectors are there to serve the public. They're really not there to go and tell owners and operators how to run their businesses or what type of environment to create. They're there as a service, as a policing agency, that if you need them, you call them. But if you don't, they leave you alone. And that's what's great about other states outside of Maryland, Pennsylvania, and New Jersey, my friend.
Yeah, we get it all here, man. I mean, it's like,
you guys got lead-based paint stuff.
Oh,
you have all kinds of. We don't have any of that. I mean, lead-based paint's still a concern. It's not like it's not a concern in other places, but the whole concept of having a lead-based paint cert on a property does not exist outside. And even now, I've never seen that outside the state of Maryland. I've only seen that in Maryland.
We're seeing that if there is someone that has a young child that has a elevated lead, man, if they're going to sue, they include places that they visited as a kid. I mean, it's oh, you went over somebody's house. Well,
I had
they might have
at
lead
my grandmother's house 3.5 months ago. And we're gonna
exactly. Yeah.
I do just want to say, just to clean that last point up, is
the views and opinions expressed by Matt Faircloth are not necessarily.
We actually work very closely with our code inspectors. I know the code inspectors' names of all of our municipalities. Like they know our properties. It's actually like when you own, we own a property that's 336 units in Winston-Salem. The town is very aware of us, and we're very aware of them. And so we're not hiding under the radar or anything. We do outreach to them like, hey, we're new owners in town here. We're going to clean this place up, right? They come out, they talk to our managers, they hear from our managers on our plans. And so a lot of times that will get us, a little bit of leniency as far as like, oh yeah, no, that's on the plan to be fixed. And here's the plan or the quotes we received. So they do work with us when we're working to improve the property. And they do recognize that we're spending, in some cases, millions of dollars on a property.
Yeah, you're fixing it up
to elevate it. Exactly.
I'm so glad I answered that question first, Justin, because you said that was such a better, well thought out answer than my like. We don't.
Justin's cleaning up what Matt has, the path.
Story of my life, Todd. Come on.
All right, Justin's thinking Matt's talking about apartments with no running water, and give them a couple of bucks off the rent.
Go to the neighbors for your water. No,
we'll bring you some water. Don't worry about it.
We run good properties. I just prefer the government to stay on their side of the street.
That's right. Yeah. You probably didn't like them telling you couldn't, evict somebody for not paying you. We'll get to that.
That was tough. Yeah. It was a tough time period for our business. Yeah.
So, you hear a lot about, if you're interested in investing in real estate, chances are you've heard of people like Grant Cardone, right? I mean, it's, the Cardone Capital and, buying apartment buildings and things like that. And, and a lot of this has sort of, with just real estate being sort of like, on the mind of anybody that is wanting to accumulate some type of wealth other than working for it, right? In a 9-to-5 job or something like that. They've thought about owning rental property. But, when you get into the big stuff, the larger complexes, we're really talking about, there's a couple ways you can get into it. One is syndication, right? So you can either, be the operator where you get people to invest their money with you, or, you can be the investor investing in the operator. Um, is the syndication side of things, I mean, is it hyped up? Is it overrated? I mean, when you listen to people like Grant Cardone, and a a lot of the, motivational stuff with this, where do you cut through it? I mean, do you think that it's somewhat overrated?
It's not like just invest in a syndication and make money like that. It's nowhere near as simple as those folks are making it sound. Because you can make a lot of money investing in a syndicated asset, and you can either lose or nowhere near make the amount of money you are told you're going to make in a syndicated asset. There's no guarantees. So it's not there's not anywhere near as much sizzle as you're hearing it. Investing in syndication should be actually pretty boring. It should be pretty straightforward, pretty clear, pretty cut and dry, less like rah, none of that, none of the sizzle that comes from those guys. And I think that there's too much theatrics put into it and too much pressure into those things, and into something that really should just be a straight up diversification tool. Don't just make all your money off of Wall Street. You should park your money in a few other things, and syndications, thank goodness for them, because they allow people, accredited, non-accredited, to put money into something that's completely unrelated to what's happening on Wall Street. And that has a whole nother slew of benefits outside of stocks and stuff like that. So, I think it's more cut and dry than it's more cut and dry than those guys are making it.
Yeah. From the operating standpoint, I mean, look, we've all watched the videos of Grant Cardone sitting in his Bentley or on his private jet. Like, if I buy properties like him, I could have a private jet too, right?
Right. That's right.
So,
don't you guys have a private jet?
Right. No.
Man, I did an Instagram post of me standing in front of an American Airlines airplane, Todd. And I was like,
right.
hey, just so you know, that's not my
economy.
plane. Right.
Right.
That's not my plane. And I went to go look at an apartment building that I'm buying with my team. I paid $400 to have a seat on that airplane, and it's not mine. And anybody could do that.
Yeah.
And that was my anti-Cardone post. I was like, not mine. Look at that.
You weren't sitting on it. You weren't straddling the nose of the plane.
No, wasn't sitting on the nose cone. Wasn't walking on the wing.
As much as he would have wanted to. Yeah.
Right. I could have written my name on the side of the plane,
But I guess as operators, you really want the syndication because you try and keep the bank out, right? I mean, aren't you trying, when you're looking at buying these, are you trying to raise the money for the entire purchase?
No.
Okay.
So we're raising the money for the down payment and upfront fees and like the capital expenditures. We're still getting a loan, but excellent terms, right? The larger the loan, the better the terms are. You would think, maybe the opposite, but it's like, oh, you want to borrow $10 million? We're going to give you like the best, cheapest money you could ever find, right?
Yeah.
Like sub-free money.
Non-recourse.
Yeah, so, exactly.
Let me give you a few comparisons, right? So let's say somebody through Saks Realty wants to buy a 4-unit, right? In right down there, right in Maryland somewhere, right? They're going to pay $400,000. They're going to have to lay down, even if they do 20% down mortgage. Let's forget about homeowner occupied. They're doing it for a rental property. 20% down. So they're going to bring $80,000 to the table out of their own pocket. They're going to bring 3% for closing costs. And then if they need to replace the roof, do the windows, do the front door, redo a couple of apartments. So they got to bring another $15,000 out of their own pocket. Right. So all in, they're into this thing for, let's say just over $100,000, right? All in. So that money has to come into their pocket. They're going to borrow the other $320,000 from a bank. But in a syndication, what you're allowed to do, like, so first of all, put a couple of zeros on that. So instead of a $400,000 property, it's me and Justin buying a $4 million property or a $40 million property. So it's around the same loan to value, believe it or not, that we get debt wise. So instead of bringing on $100,000 to the table, Justin and I might be bringing $1 million or $10 million to the table. Now, we don't write a check for that like somebody that's buying a smaller property would. We can then syndicate that. We're bringing in debt It's just like a homeowner would, or a small investment buyer would. But then the money that you got to come with the other side of it, like the equity, the cash out of your pocket, instead of out of your pocket, you go to investors' pockets, and they all write checks. And it doesn't have to come from one investor. You could get that $1 million from 10 or 100 people, and they all get a little slice of the pie, a little slice of ownership, and you get a slice of pie for putting the whole thing together. And if you want to invest in it too, you can. So in essence, that's the syndication, and there's a slew of benefits, as Justin said, on the larger side. One of the benefits to underscore here, that's something that Justin said, was, yes, I have to borrow money to buy an apartment building. Yes, somebody that buys a fourplex through Saks Realty also has to borrow money, but they sign a personal guarantee when they buy that property through Saks Realty, meaning like, it's, the 320 grand. If they don't make those monthly payments, man, the bank's not only going to come and take the house, they're going to put a lien on that person's name and, bankrupt their personal credit and all that kind of stuff. And this would never happen, but God forbid, if one of our properties ever went upside down and the bank had to take it back, we are not on the personal guarantee hook. It's called non-recourse. And so it's you as the buyer, the property becomes the main collateral, not the buyer themselves.
If you buy a $4 million, or just say a $10 million property apartment complex, when you raise the money, for your down payment, how much through the approval process is dependent upon your ability as an operator? So are they looking for an experience level at that point? Did you have to build your way up and say, hey, I managed, 8 4 units?
Mm-hmm.
What was that process like?
It's 80% of the process is about your track record it's called, at that level, it's called the sponsor. So it's the sponsor's experience is what 80% of the decision is about with the bank. Last couple of deals we did, Todd, they didn't even run my credit. Doesn't matter. Who cares what my credit score is? Does it really matter? They may do it and I don't know about it, but I've rarely signed off on things that authorize them to do that. Maybe they do it behind the scenes. I've done a few bigger deals. They didn't even ask for my tax returns. Why? You don't need that. Let's look at the deal. They want to do the resume. They want to know what Justin's been managing. They want to know what our property track record is. They want to know, tell us all about the deals that you guys manage. And then they want to how'd that go? How's that going? What's the rent? What rent bumps have you seen on the properties that you've done? Our assets under control that we own is an enormous part of the conversation.
So your first, just kind of remind us again. So you did a couple smaller deals, but then you guys bought a bigger deal. And was that the one that was your first one? What was it? Was it 300 plus units? What was the first big, how many units was your?
Well, so it was me. I bought a lot of small stuff, and then we were attracting a lot more investors. And so we decided to stretch up, and me and a partner named Ben stretched up and bought this 198 unit. And then this, young little Spitfire shows up named Justin, that had some extra time on his hands. Justin, you can go into that if you want. And decided to go on a ride with me down to North Carolina. And he comes to this 198 unit that me and Ben just bought, and we're trying to find heads or tails of the place. And I'm like, hey, Justin, why don't you help me out? Can you go talk to this contractor? Because he says we owe money. And can you also go and meet this guy over at this property? He comes back a half an hour later. He's like, me and the guy worked out the thing with the money. You don't owe him anything. We talked it out. I've met the guy over there at that property, and I also took notes, and you need to make these 4 repairs while you're here and everything like that. And I'm like, this guy, So I realized very quickly that I needed a personality unlike mine, but like Justin's. It's very, detail oriented and process oriented and able to just get in and figure things out, And so with the team of me and Justin and a few others that joined us later, we've been able to form a really solid unit that's able to, find, evaluate, raise capital for, and manage these properties over and over and over again. And I don't think that me and my partner Ben would have had such a great outcome on this 198 unit in North Carolina had it not been for Justin coming in and helping us turn that ship around.
So 198 units, that was really your first
big property.
Big purchase. That's a lot of units in one place. You have probably an on-site manager, at that point you really stepped up. what were some of the, I guess, the initial things that you had to learn real quick? I mean, were you like, what the heck did we just do? Like, this is
Yeah.
terrible. Were you not sleeping at night? I mean, I think of
Yeah.
going out and buying 198 units as like a full-time job.
It's not that. Well, I'm gonna let Justin tell you some like lessons that we had for that things that properties called Douglas Square, right? Justin will tell the story of what Douglas Square taught us. But what's interesting, Todd, is that it's not a full-time job owning that property. It's someone else's full-time job, right? And so when you buy a duplex or a triplex or a 10 unit, or I've owned 10 units, 30 units, right? Best you're going to get is 10 to 20% of somebody else's time to run that property for you, like a property management company who's going to overwork their staff and give their staff the most amount of units they can to manage without the staff quitting, right? Whereas if you buy a 198 unit, right, that property in North Carolina that we're referring to had four full-time employees, right? And because of the rent that it generated, it was able to swing payroll. It had a site manager, a leasing agent, and 2 maintenance technicians. And because the property generated enough, it could afford all those that staff. So what the magic is, Todd, is that as you get into larger and larger units, less and less of your time goes into the day-to-day. I've spent way more time on a 49 unit that I have than I do on larger properties. And Justin, Justin's got a 40 something down in Virginia. And you would attest to that as well.
Absolutely.
If you don't have on-site staff, you as the owner have a lot more time involved. And then you can do lessons on Douglas if you like.
Somewhere around 100 units, you can start usually paying to have some on-site staff, full-time employees of your property. And that's really, I think, the tipping point, the game changer, as far as from what I would consider smaller multi to larger multi, which is what we do. We would never consider. We would never consider a property that could not have full-time staff there.
Yeah. So who was qualified to work the numbers to say, whether this is, you say you bought that 198 units and it had 4 full-time employees and the rent could pay for the employees. At what point, I mean, were you bringing in your CPA? I mean, who was sitting down with you? I always think about this and I go, who is the financial brains behind it? That if someone doesn't have that skill, they may be great managers or they may be great at, design or making a community better. Who brings in the mathematician that says, this is the way that this should operate or work. These are the numbers. And, this is where what you have to work towards to make it more financially beneficial.
Yeah. So there's 4 key roles on our team, right? And the roles are the person that finds the deal. We call that the hunter. Then there's the person that raises the capital for the deal. That's the money. That's me and this guy named Hervé. And this person that runs the business plan on the deal, that implements the vision and makes the property fly. And that's Justin. That's, he browbeats the property manager, browbeats the contractors, and it is the boots on the ground or manages boots on the ground. The fourth person is, we call him the brain, but the technical term for him is underwriter, right? And the underwriter is the one that takes that deal and weighs out all the different parameters and weighs out all the if this then that's, and plays the market card and says, okay, we think the market's going to do this, we think rents are going to go up, think this is going to go down, whatever. And they determine the business plan for the property. And they write that business plan up and they hand it to Justin, and he says, okay, that dog will hunt. I can, there's enough money in here for me to manage this, for me to properly bring this asset around. He has to go tour it and say, okay, yeah, I can do this because I need this. It's got enough money for this. And there's a big old crack in this wall over here that I can take this money to fix and everything like that. So he agrees to the business plan, signs off on it, and then he implements it. Then either that brain person, the underwriter, does a monthly underwriting on the financials from the property, right? And every property management company, that company has in-house accounting. And so they send us a monthly financial statement in whatever software they're using, and we take it and we crunch it and compare it to our business plan to see how it looks, right? We use a CFO for that, but your CPA can do it for you. If somebody just getting started, or just somebody with a financial mind. But the bottom line, Todd, is it takes a few different personalities to be successful in multifamily investing. And one of those is a financially oriented analyst. Another one's like Justin, who is a process oriented implementer, another one's a schmoozy money talking guy like myself, another one is someone who's a hard hitting, broker type that's going to go and find deals, those are the 4 seats on the multifamily bus that you have to be successful. Justin, what do you think?
I agree on all counts. Todd, if anyone in your audience is like, man, I don't have, like, our underwriter was literally a rocket scientist. If I don't have a rocket scientist on my team who knows this kind of stuff, the property management company, if you build a good relationship with them, even before you buy a property, they know the market very well. And so we actually match up. We have the property manager do a pro forma and we do a pro forma, and we compare and see what the difference is. And so we've gotten pretty good where our numbers are usually pretty tight with our managers. And then, we now have years of experience to prove out and know, okay, this was off or this was right and this is wrong. And so we have a lot of experienced numbers to base it on. But if you're just sort of starting out and you don't know where to turn, I would say look at the property manager first, and they might be able to give you some good guidance on underwriting a deal.
And I guess all this is happening fast, right? So I would imagine with the market as it is, you probably have a lot of competition that are looking at these complexes as well at the same time. So what is kind of like, you see something that's on the market or somebody approaches you with an off-market deal, what kind of time frame do you have, to crunch those numbers, do the pro formas? I mean, is it weeks?
It's not like the residential stuff that the velocity is not as fast as some of the smaller residential deals. Thank goodness, right? Like, it's not like stuff's going under contract in 24 hours, because that's probably the kind of stuff you're seeing, right, Todd? Where it's just it's in and out, right? Yeah. The brokers are smart enough to know that if they leave that property out there for a couple of weeks or a month, they can create this frenzy bidding war, Looney Tune time, where you got to bid 2 and 3 times. It's like Groundhog's Day, Todd. Like, you turn a bid in and it's like, okay, now give us your best bid. I was like, what do you think that was? This is my best foot forward, right? I'm not going to take it. No, give us another number. And so you give them that's called the best and final rounds. You put a price out for that. Then they interview the buyers. Then they want to make you fill out a questionnaire, and they vet you a little bit further. And all the while, the broker's pushing you to increase your price. And I've seen stuff go up 10, 15% during that best and final process. Now, if the brokers are smart, that process takes another 2 to 3 weeks. And they can juice another 10, 15% out of the buyers in that time frame. And it's crazy being a part of. But Justin and I have been a part of the buying side of that, and we've been a part of the selling side of that. And it's just, you just keep scratching your head on where things are going, whether even you're on your both sides of it. And these brokers are like, maestros, the way that they can get things to go up. But yeah, typically, to answer your question, it's around 30 to 45 days all in from listing to under contract.
That being said, there's a lot to do, more than like a single family house. So if we get an email today from a broker that says, hey, I got 200 units in this market you're looking at, and so like our underwriter will give it a first pass real quick, maybe within a day, and say, yeah, we're fairly close. You might say we're 80% of their asking or 90% of their asking. Then usually, if it's someone local, we'll try to get on the ground, do a tour, really understand what's happening, what the opportunity is. Maybe then I'll get my manager to look at it. And so there's a few steps there that take, like, scheduling and time and trips and investment. And then you say, okay, let's get to the point. Okay, now we're ready to submit our offer. So it takes a team, that all those people that Matt mentioned on our team working together. So it's pretty much from go. It's like there's always movement, and we're not sitting around waiting. So we need those few weeks. We need those 3 weeks to get all that information together.
Let's talk about the market a little bit. So, but we do have one question from Ruth. Do you need to be an accredited investor to invest with DeRosa? And are you an S corp?
Yeah, I'll gladly take that. So, not all the time. An accredited investor is someone who, earns over a certain dollar amount or has a certain amount of net worth. You do not have to be accredited to invest with this route, but you do need to have a pre-existing relationship with. We can set up for you by just having a conversation with one of our staff, and you can make that happen by just going to DeRosaGroup.com, DEROSA Group.com, and we can take the next steps for you there. DeRosa Group is an S corp, and that's because. Long story, but any company that takes fees along with pass-through real estate and things like that you want to be an S corp if you're taking fees or have earned income on top of everything else.
Great. Thanks, Ruth, for your question. Anybody else have questions? Go ahead and comment them in. So let's talk about affordability. Obviously, I mean, you're seeing, I'll ask you, are you seeing a lack of supply with apartments? I mean, even in your markets in Kentucky and North Carolina, I mean, are they, I know here in Maryland, we have wait lists.
Well, not on the rental side. I mean, Justin will have to comment on the rental side. I'll comment on the acquisition side. Justin
Sure.
can comment on the rental side because he might have a different answer than I do. On buying a property, there is certainly not a supply issue. There's a lot of properties that are on the market. What there is an issue of is a pricing issue. Like these properties just aren't trading for where they make sense financially, right? And that. So we're only investing in 2 markets right now: Lexington, Kentucky, Winston-Salem, North Carolina. That's it. And we've underwritten, Todd, like 240 deals in the since the beginning of this year, right? So that's a lot of deals that have come on the market in mid-sized multifamily. But of those 240, I want to tell you, we made like 15 offers, like formal written offers, made it through bidding process and then missed and hit maybe like 3 of that 240, right? So it's been a long, it's a lot to underwrite. Justin could comment on the rental side.
Well, we had a fairly slow year because prices are high, and properties, they're out there. There's properties for sale in every market that are 100+ unit properties that we would love to buy, and we made some runs on a lot of properties this summer, and just missed. And when we're missing by like $4, $5, $8 million, it's like, man, I don't know how they're paying that, but what are you gonna do, right? And so we stick to our numbers, and we're pretty strict about our underwriting. Lately, we're on a good run. We've got a few that we're working on right now, coming soon, and it's been lucky. So it kind of ebbs and flows as far as deal flow goes. We are able to underwrite to some higher rent projections than we had in the past, given the way the market's been, which I think is where you want to kind of talk about is, there are in a lot of good properties, there are lines out the door, like you said, and I think that's in all asset classes. I mean, I don't know about A really, but in the B's and C's that we have, I know that at that one property in Winston-Salem, that 336 unit, we have tenants that are signed up for January move-ins right now, and here we are at the end of November, and so they're already signed up for the unit that we haven't even touched to start renovating yet, but is on the schedule to be ready in January. So we've got a lot of demand, and we've been raising rents, and we're raising rents to try to keep up with the market. But in some markets, we're seeing 10-12% rent growth or more this year. And we want to obviously keep pace with that. It's excellent from the income side, but yeah, it's raising everything up right now.
What about as far as what are you looking for in like the apartment, as far as how many bedrooms? Do you prefer a 1-bedroom and a den or office versus a 2-bedroom? I hear different investors say, different things as to what they like. What do you guys like?
I prefer a mix. There are I mean, I've heard this, kind of meme that's like if you have like a 2-bedroom or a 3-bedroom, you end up attracting these little animals that don't do well in confined spaces, and they're called kids, right? But in a 1-bedroom, you're not supposed to, not supposed to have kids. You do, but kids are just little, they're just little accidents waiting to happen, right? So some would say that if you want a property that doesn't have damage from kids and things like that, you would steer away from 2-3-bedroom properties. I personally prefer a nice mix, like a 50-50 split of 1 and 2-bedroom units, because then from a lease up standpoint, you've always got something you can offer to the market, like a 1 and a 2. We've got some properties that have 3 bedrooms, but they're kind of oddball because they take a lot of square footage. So you don't see that many multifamily that have, Justin and I own some 3-bedroom properties that have 3 bedrooms, and I've got one that's got some 4 bedrooms and stuff like that in it. But you don't see that very frequently. It's typically 1s and 2s that you see on the market. I prefer a nice mix. Justin, what do you think?
I agree. We tend to want to stay away from, look, unit mix is a factor, but if it was all studios, maybe we might be a little less interested in transitional, right? That would be, it'd have to be paired with something that had 2 or 3 bedrooms type property. But man, the 3 bedrooms, I'm getting like usually a $500 rent bump to go from a 2 to a 3. So if you've got the space for it, if you can do it, or you already have them there right now, this year, 3 bedrooms are in high demand. Even if, people are, with the home offices with the pandemic, they want that 3rd bedroom just to be set up so that their computer is not crammed in their bedroom with them or in their living room or something. Mm-hmm. So 3 bedrooms are in high demand right now from what we've seen, and people are paying a really heavy premium for them.
I talked to a lot of landlords that have shared, some similar experience with the, not getting the rent during the pandemic and the eviction moratorium, making it very difficult for them to survive, get people out there. What is your position, or what are you doing differently about your current lease contracts, if anything, that talks about pandemics? Or are you giving, I hear some people say, they don't want to do annual leases anymore. They will only sign month to month. Are you implementing anything like this?
We are not really doing that. And you have to be careful with fair housing regulations. That applies no matter what market you're in, right? So we have to make sure we're following all the fair housing guidelines. But for us, it's about just being strict. Given the amount of demand for rental housing, we can be very strict on our qualifications, and we can be very strict on the income requirements and making sure that we're not flexing on whether it be, payment history or whatnot. And so we screen hard. We have good managers that screen our tenants or our prospects very hard. But we have not made any sort of global changes to go month to month or anything like that. If the tenants do want to go month to month, that's generally fine with us. We actually do charge usually a premium, between $100 to $200 for a month to month on top of that. But I would say only a small percentage of our tenants are doing that.
When you're talking about screening and things like that, have you changed your qualifications as far as, since the pandemic? Did you bump your
I wouldn't
scores?
say that we had to change our qualifications, but we can, where in the past, if we're a little dry or we haven't gotten it, we got a few units sitting there, we might relax the income requirement a little bit, or maybe accept someone that was evicted a few years ago. And we don't have to do that now. We don't have to relax any of our standards because there's plenty of great applicants. But we're not making any huge changes like that.
And I can say I've had to do that in the past at properties, and as a testament now to the assets that Justin's managing and the quality of life that he's creating with the renovations that we've done and with the unit conditions that we're creating and everything like that. We haven't had to discount in a really long time or compromise lease terms or compromise approval price. Typically, we require 3 times the rent in earned income. We haven't had to compromise that ever. I have in the past, many, many years ago, because, not knowing what I know now is that the asset quality, the living quality that we were creating wasn't going to attract the tenant that was going to qualify for a higher standard at that property. So luckily enough, we haven't had to do that.
How do you deal with pets? I hear people say it's kind of getting out of control, this, service pets. That I've heard people say, they can't ask for proof that it's a service pet. I've heard people say that's not true. You certainly can require proof. I mean, do you see where this is being abused?
I'm curious to get
that I
Justin's
can tell
thought on
you
this
is
one.
that,
I got my own thoughts too, but I should probably go first. But
let me go
first
and set the stage. In that we hire our property managers who take care of our properties are experts, and they know all the laws and exactly what they can and cannot say, and what they can and cannot ask. And if there is a certification to be provided, we are asking for those certifications. And if someone is trying some funny business, we can usually figure it out. And our maintenance team and our leasing team is all over our properties, and they know who's sneaking pets on and who's not. That being said, we are generally across the portfolio very pet friendly. We have pet parks in every property. We charge a non-refundable fee up front. We charge them pet rent on top of that. And we see that we can get a premium because tenants right now, they want those bigger spaces and they want their pets. And so we charge them for it, and generally works out for us.
All right. The views and opinions expressed by Matt Faircloth are not necessarily the views and opinions.
Here we go.
So here's a few things. Pets are money makers. Okay. People are attached to pets and they treat them like little people, and they give them names and they give them little sweaters and they give them little everythings, and they will gladly pay you $25 a month per animal plus a couple $100 for the pet to move in. So we will gladly accept pets. And that's why in the renovated units that Justin and I do, partly because of kids and also partly because of pets, we rarely put carpet in any of the living areas. But carpet typically lives in just the bedroom. And that is because of pets. And Justin and I were out in North Carolina at a property we were buying last week, and the carpets reeked of pets, of pet odor and pet, what,
Still
right?
smell it.
So pets make mess, man. Pets make a mess.
Yeah.
And so it is the landlord's, I think, duty to charge a fee for pets because of what pets tend to leave behind. It's okay. I grew up with pets, and that's I'm a fan thereof. One more comment with regards to the whole service animal thing. I'm fine with that, and we don't fight people that claim that they have a service animal, but there is no law that I've ever seen, and I think this includes like not just an emotional support animal, but like full on like seeing eye dog. If a tenant showed up at my property with a seeing eye dog, it's not that I would do this, but I would think they would expect to pay a pet fee for that animal. That is still an animal, right? It is there for their service. I get that. Maybe we would compromise that because we are nice people as well. But I've had people when I was landlording myself, to try and get their way out of paying a pet fee by telling me that the certificate they downloaded off the internet, that telling me it was an emotional support dog, like got them out of paying a pet fee. No. Like that's my beef with pets there and all that, and the emotional support thing or the service animal thing that people use, because we don't shut our doors to pets. We allow them, right? It's fine. As long as we're willing to pay the pet fee, I'm fine for them to have it. It's when people try and use those certs to get out from under paying the fee that I get my back up. So
yeah. Let's talk about security and privacy, because I'm wondering whether, where this is going. And, I've looked at a bunch of leases, and especially apartment complex leases, and they talk about you being on their surveillance cameras. You see it in there and I even saw a lease that waived the rights, basically that they could use your picture and and post you on their website or what. It's kind of strange. Yeah. Like a license, right?
No, use your likeness. Right. Yeah.
Oh, likeness. Yes. Likeness. Yeah. But really, I see this as, a lot of tenants have like Ring doorbells, right? And they're recording audio. They're recording when people are walking past their door, or maybe when they're standing out in a hallway. I mean, are you seeing anything or planning anything as far as modifying your leases to include, or do you have anything in there about surveillance, or to include other tenants as far as their privacy and or them being recorded, maybe in
So
either audio or video?
if it's, a tenant's Ring doorbell, recording another tenant or something, that is something we want to stay out of. That is between the tenants, and that's not something that we're interested in getting in the middle of. If we have some security cameras, we just rolled out security cameras at one of our projects. And there are signs posted that says, recording in progress. I don't remember exact the language. I don't think there's anything specific in our lease that we had to put in there about it, because it's posted clearly in a public place. It's in parking lots. It's not like we have cameras inside their units or anything. And so it's just a public notice that says, you may be being recorded right now, something along those lines. And one key thing there is that we do not, and this might be in our lease, or it's at least a policy, is that footage is not available to the tenants, right? Unless it is available for us and the owners, the management company, and the police department, should they request it. Don't come to me if you've got, someone keyed your car and you want to look at the footage. That is not what those cameras are there for. And so we do have a policy around that. Because otherwise you could have tenants all day coming in to, look at the cameras and all that.
I'll give you my personal opinion on this one, right? I think that we've gotten beyond, people's rights of privacy, I think, in some ways around these in the world and everything like that. And so there's certainly not unless I don't know about it, there wouldn't be a clause in a DeRosa Group lease or anything that we own that says we have the right to your likeness or anything like that.
No,
I mean, I'm cautious when we shoot YouTube videos and that kind of thing on who's in it and who agrees to it. And, we'll blur out faces if we have to, or if people let us know, hey, I don't want to be in that video, whatever, we'll just delete it. So I don't, I'm cautious of people's privacy if they don't want to be online. You better believe I'm not going to go shoot Instagram and force one of my tenants to be in it or something like that, or just not tell them I'm coming in and I'm going to go live in their apartment or something like that. I mean, it's, these little things have allowed us to go, to put a lot online really quickly in that. So I'm sensitive to people's privacy.
So what do you think about, the commercial space? I know you do some commercial too, and we've got a couple minutes left here, and I kind of want to talk about, if someone is looking for an opportunity to get into multifamily, and you see office space starting to not look so good. I mean, I'm hearing more and more every day about how people saying, hey, they've gone on, permanent remote work, and their businesses are going to more like co-working space if it's necessary. These big office leases are just, there's vacancies going on across the country. Do you see an opportunity? Because, with commercial space, I know like here in Maryland, it's an easier process to get these commercial buildings converted to residential multifamily, because it's a lower density, right, than it is an office space. I mean, you're talking about less parking needs, and a lot of these office buildings have big parking lots. Are you guys like standing in wait and, hoping to gobble that some of this potential inventory that could hit the market?
We've looked at a few. Like Justin walked a hotel that was a foreclosed on hotel that was up for sale, that we originally thought that would be a good conversion to multifamily. That you see a lot more hotels, because you got, what do you got in a hotel? You got plumbing, you got bathrooms, you got, delineated units. They're really small units, but maybe you merge a few of them or something like that. So hotels are possible. If I could clone Justin Fraser and make more Justins, then I would I would think that I would probably look for DeRosa to get involved in a couple of different spaces. And that is, as you said, the changing world of office space. America's going to go to work differently now, right? And so we're not going to need the amount of office space that we had. So whoever can figure out what that is, whether that's WeWork or turning office spaces into multifamily, whatever, there's somebody that's going to make billions in this world in converting office spaces and also converting strip centers into new things, like turning a strip center down the street from your house into a school or into a medical center or whatever. Somebody's going to figure out what to do with this real estate that got built from like 1960 till 2019, right? That's not going to be used the way that it was pre-COVID, right? I don't know if it'll be DeRosa Group or not. If I could clone Justin, I would push DeRosa into, believe it or not, flex industrial space, because I think it's something that America needs more of. There's going to be more and more stuff, more and more small businesses that are going to be shipping things from one place to another. Small startups want to be Amazons or Amazon, little pilot facilities or whatever. So I would get us into flex industrial if I could get us into something else, not self-storage. It's overbought, overbuilt. I'm curious what you think, Justin. Right now, I mean, to be honest, Todd, we're going to stick with multifamily. To bring Justin some peace, that we're going to stick to buying as many apartment buildings as we can over the next couple of years. But I'm curious what Justin thinks about other asset classes.
There's something to be said for taking advantage of an opportunity. But we've had the most success when we rein it in and we focus in and go deep on what we know. Matt said we're only buying in 2 markets because we are going very deep on what we know, right? We know 2 markets super well, right? If we're going to add a 3rd market, we need to know it super well. And we go really, really deep. We know multifamily, C-class, value add. We know how to take a property, put the money in the right places, clean out the crime, clean up the tenant base, and make that property sing. We are really, really good at that. And so to then take those skills, some of them would transfer to office, but there's a learning curve, and now you're just taking a few steps back. And so it makes sense in some ways if we had the team capacity, if we felt like there just wasn't future opportunity or the opportunities were drying up for what we were going after, what we knew. That's a different story. But for someone in your audience, that's shiny object syndrome is a tough thing to follow. And you hear about crypto and this and that, and buying strip malls or not, or like there's so many great things. There's so many great ways you can make money in real estate, even just within real estate. That I say pick a few, figure out what you're good at, and then go real deep. And the deeper we go, the more success we have, and that's proven to work really well for us.
Well, guys, we really appreciate it.
Yeah,
thank you so much for your time tonight.
Thanks for having us, Todd.
If anybody wants to reach,
trying to catch up, I feel like we could do this for 3 more hours.
Yeah,
we
fun,
could.
Right?
We could. If anybody would like to reach out to Matt or Justin, just comment. All their information's in the show notes. And guys, we appreciate your time tonight and learning about apartments. And until next week, we'll see you soon.
Thanks for having us.